Picture this. You're scrolling through social media and see your friend posting about their crypto gains, your colleague bragging about their stock picks, and influencers flashing their trading profits. Meanwhile, you're sitting there with money in your savings account earning practically nothing, wondering if you're missing out on something huge. Well, here's the truth that nobody wants to tell you. Most of those people showing off their wins are about to lose it all because they're breaking the fundamental rules of investing. Today, I'm going to share with you the 6 basic rules of investing that separate the winners from the losers, the wealthy from the broke, and the smart money from the dumb money. These aren't just theoretical concepts from some dusty finance textbook. These are battle-tested principles that have created more millionaires than any get-rich-quick scheme ever will. And if you stick around until the end, I'll reveal the one rule that most investors break that destroys their wealth faster than a house fire. But first, let me ask you something. How many times have you heard someone say they're going to start investing next month, next year, or when they have more money? If you're nodding your head right now, you're already breaking the first rule, and it's costing you more than you realize. Rule number 1. Start now, not tomorrow. The biggest mistake people make isn't picking the wrong stocks or timing the market poorly. It's waiting to start. Time is your most powerful ally in investing, but it's also your most unforgiving enemy when wasted. Let me show you exactly what I mean with a story that will shock you. Meet Sarah and Mike, 2 friends who graduated college together. Sarah started investing just $100 per month at age 22. Mike thought he was smart and waited until he was 32 to start. But then he invested $200 per month, double what Sarah put in. Both earned the same 7% annual return. Who do you think had more money at retirement? Sarah, who started earlier with less money, ended up with over $200,000 more than Mike. That's the power of compound interest, and it's why starting now, even with small amounts, beats waiting to invest larger amounts later. But here's what most people don't understand. Compound interest isn't just about money growing. It's about time literally working for you while you sleep. Every day you wait is a day you lose that you can never get back. Your future self is either going to thank you or curse you for the decision you make today. The excuse I hear most often is, I don't have enough money to start investing. This is like saying you don't have enough money to save money. You can start investing with as little as $5 today. The amount doesn't matter, the habit does, because once you start, you'll find ways to invest more. Rule number 2, diversification is your safety net. Now here's where most new investors go catastrophically wrong. They hear about someone making huge gains on a single stock or cryptocurrency, and they think they can do the same thing. This is like hearing about someone winning the lottery and thinking you should spend your entire paycheck on tickets. Diversification isn't just about not putting all your eggs in one basket. It's about having different types of baskets in different locations, carried by different people at different times. When you diversify properly, you're not just spreading risk. You're positioning yourself to capture gains from multiple sources while protecting against catastrophic losses. Think about it this way. If you put all your money in one company's stock, you're basically betting your entire financial future on the decisions of people you've never met, in a company you don't control, in an industry that could be disrupted overnight. That's not investing, that's gambling. True diversification means spreading your investments across different asset classes, stocks, bonds, real estate, and even international markets. It means having exposure to different sectors of the economy, different company sizes, and different geographic regions. Yes, this means you won't hit the jackpot if one investment explodes higher, but it also means you won't lose everything if one investment explodes lower. The math is simple. If you have 10 investments and one goes to zero, you lose 10%. If you have one investment and it goes to zero, you lose everything. Which scenario would you rather face? Rule number 3, time in the market beats timing the market. This is where even smart people get stupid. They think they can predict when the market will go up or down, when to buy and when to sell. They watch the news, follow market gurus, and try to time their purchases for the perfect moment. Here's the brutal truth. You can't time the market, and neither can the professionals. Studies have shown that even professional money managers who do this for a living fail to beat the market consistently over long periods. In fact, over the past 20 years, nearly 90% of actively managed funds failed to outperform simple index funds. These are people with teams of analysts, sophisticated computer models, and access to information you'll never have. If they can't time the market, what makes you think you can? But here's the real kicker. Missing just the 10 best days in the market over a 20-year period would cut your returns by more than half. The problem is, those best days often come right after the worst days. While you're sitting on the sidelines waiting for the perfect time to invest, the market is making money without you. The winning strategy isn't timing the market, it's time in the market. Consistent, regular investing, regardless of market conditions, has created more wealth than any timing strategy ever devised. This is called dollar cost averaging, and it's your secret weapon against market volatility. When you invest the same amount regularly, you automatically buy more shares when prices are low and fewer shares when prices are high. Over time, this smooths out the volatility and often results in a better average price than trying to time your purchases perfectly. Rule number 4, understand your risk tolerance. Here's where most people lie to themselves and pay the price later. They think they can handle big swings in their investments until they actually experience them. Then they panic, sell at the worst possible time, and lock in their losses permanently. Your risk tolerance isn't just about how much money you can afford to lose. It's about how much volatility you can stomach without making emotional decisions that destroy your long-term wealth. And here's the thing. Everyone thinks they're a risk taker until they watch their portfolio drop 20% in a month. Risk tolerance has two components: your financial ability to take risk and your emotional ability to take risk. You might be able to afford to lose money financially, but if market swings keep you up at night or cause you to make panic decisions, you're taking too much risk. The key is to match your investments to your risk tolerance, not the other way around. If you're young and have decades until retirement, you can afford to take more risk because you have time to recover from market downturns. If you're older or need the money soon, you should take less risk, even if it means lower potential returns. But here's the advanced concept most people miss. Your risk tolerance should also consider your investment timeline. Money you need in the next 5 years shouldn't be invested the same way as money you won't need for 30 years. This is called asset allocation, and it's the difference between investing and gambling. Rule number 5, keep your costs low. This is the silent killer of investment returns, and most people don't even realize it's happening. Every fee you pay, every expense ratio, every trading commission is money that comes directly out of your returns. And because of compound interest, these small fees compound over time into enormous amounts. Let me give you an example that will blow your mind. If you invest $10,000 and earn a 7% annual return, after 30 years, you'll have over $76,000. But if you pay just 1% in fees annually, your ending balance drops to about $55,000. That 1% fee cost you over $20,000 in wealth. The investment industry makes billions of dollars from these fees, and they're very good at making them seem small and insignificant. They'll show you percentages that look tiny, but they don't show you the cumulative impact over decades of investing. The solution is simple: minimize fees wherever possible. Choose low-cost index funds over expensive actively managed funds. Use discount brokers instead of full-service brokers. Avoid investments with high expense ratios and hidden fees. Every dollar you save in fees is a dollar that stays in your pocket and compounds for your benefit. But here's the thing most people don't understand. The cheapest option isn't always the best option. You need to balance cost with quality and make sure you're getting good value for any fees you do pay. A slightly higher fee might be worth it if it gives you access to better diversification or professional management that you couldn't achieve on your own. Rule number 6, stay disciplined and consistent. This is the rule that separates the wealthy from everyone else, and it's the hardest one to follow. Staying disciplined means continuing to invest even when the market is scary, even when the news is terrible, even when everyone around you is panicking. The biggest enemy of investment success isn't market crashes or economic recessions, it's your own emotions. Fear and greed drive most investment decisions, and they're almost always wrong. When the market is soaring, Greed makes you want to invest more and take bigger risks. When the market is crashing, fear makes you want to sell everything and hide under your bed. Discipline means having a plan and sticking to it regardless of market conditions. It means continuing to invest your regular amount even when stocks are expensive. It means not selling when the market crashes and the news is predicting the end of the world. It means staying focused on your long-term goals instead of reacting to short-term market movements. Consistency is equally important. The investors who build real wealth aren't the ones who make huge investments occasionally. They're the ones who make smaller investments regularly, month after month, year after year, decade after decade. This consistency allows compound interest to work its magic and smooths out the volatility of the markets. But here's the secret that most people never learn. Discipline and consistency become easier when you automate your investments. Set up automatic transfers from your checking account to your investment account. Make investing a habit, not a decision you have to make every month. The hidden rule that destroys wealth. Now, as promised, let me reveal the one rule that most investors break that destroys their wealth faster than anything else. They let emotions drive their investment decisions. This isn't just about panic selling during market crashes. This is about making any investment decision based on how you feel instead of what the data shows. Emotional investing shows up in many ways. Buying stocks because you like the company's products, selling investments because you need to do something during volatile times, chasing last year's hot investment, avoiding investments because they seem boring or unfamiliar. All of these are emotional decisions disguised as rational ones. The solution is to remove emotions from your investment process as much as possible. Create a written investment plan when you're calm and rational, then stick to it regardless of how you feel. Use systematic approaches like dollar cost averaging instead of trying to time your investments. Focus on long-term goals instead of short-term market movements. Your next steps. These 6 rules aren't just suggestions. They're the foundation of successful investing. Start now, even if it's with a small amount. Diversify your investments across different asset classes and sectors. Stay invested for the long term instead of trying to time the market. Match your investments to your risk tolerance and timeline. Keep your costs as low as possible. And most importantly, stay disciplined and consistent, regardless of what the market does. The difference between wealthy investors and everyone else isn't intelligence, luck, or even the amount of money they started with. It's following these basic rules consistently over time. The investors who get rich aren't the ones who find the secret investment that nobody else knows about. They're the ones who do the boring, simple things that everyone knows about, but few people actually do. Remember, investing isn't about getting rich quick. It's about getting rich for sure. These rules have worked for decades through multiple market crashes, economic recessions, and periods of uncertainty. They'll work for you too, but only if you follow them consistently. The question isn't whether these rules work. The question is whether you'll have the discipline to follow them. Your future self is counting on the decision you make today. Don't let them down. If this video helped you understand the fundamentals of investing, make sure to like and subscribe for more content that will help you build wealth the right way. And remember, the best time to start investing was yesterday. The second best time is right now.